Well, ladies and gentlemen, um, Wolf Richter, Wolf Street. Is this more proof that the all-time high in rent, housing, mortgage, everything, the bubble 2.0 I keep talking about, is this more proof that it absolutely was the top and it's now time to drop? Now, if you look at Martin Armstrong's charts and things that go back decades, have always shown that at the end of 2016 to the year 2032 or 2033, roughly, real estate is just in a steady decline all the way down. Now, being that I'm, getting near 40 years old, and you do the math on a typical 30-year mortgage, I would be 70 years old paying this house off. We're, again, this close to getting in the next month or two or whatever. So we're in, I'll be 40, this year, by the end of the year. So you're talking 70 years old. I'd like to retire a little earlier than 70, and in other words, not have to keep making a mortgage payment, which is why I'm going to be making big payments on the house throughout whenever the opportunity arises. But the point is, imagine I wait 5 years. You know what? I really want to capitalize big time on the housing bust that's coming. And in, 4 or 5 years from now, boy, am I going to get a freaking fire sale sweetheart deal. But again, most people, when you get a house, whether it's, if you're at the all-time high or not the all-time high, you're going to get a 30-year mortgage. Now, you might argue, yeah, but Jay Snip, man, if the mortgages and the housing prices come down, not mortgages, but the housing prices come down significantly in 5 years, like in other words, let's say they're 50% of where they're at, today. So a $300,000 house is $150,000. Oh boy, it would make sense to wait 5 years because you could easily pay that off really quick, right? You can get a 15-year mortgage maybe. So my question is, usually when housing comes down that kind of significantly, that kind of, those kind of prices or those kind of percentages, you normally have interest rates rising. Normally. So even though it's a $150,000 house, and you think in today's terms of 3.8, 4% interest on a house mortgage, in 5 years we may be paying 6, 8, 10% interest, right? We saw what the 80s did. So if that's the case, whatever your monthly payment is today on a $300,000 house, it'll likely be around the same monthly payment due to the high interest on a $150,000 house if the interest rates rise. And again, history shows us that they pretty much do. So again, do you want to wait 5 years to capitalize? And you might. See, this is real beneficial if you've got a chunk of money on the sideline ready to get a fire sale deal where you don't really have to rely on a bank with their high interest rates at the time, in the future, suppose, they'll go up to give you the mortgage. But you might say, oh, that $300,000 house is $150,000, and I've got $100,000 saved up, got $100K. I'm going to get a $50K mortgage. Well, at $50K at, 6, 7, 8%, not a bad idea, right? So in certain circumstances, it might make sense. Now, of course, if you got the cash saved up, maybe you played the crypto game, silver and gold exploded, all the above, you capitalize, I got the cash to buy a house. You're going to be the one that really handled business nicely because the interest rate won't matter, and all you're concerned about is what's the house price right now. But again, someone like me, and I think a lot of people, we're not going to sit here and wait years and years and years to capitalize on something when, the clock's ticking. In 5 more years, I'll be nearly, 45 years old. I can't go get a mortgage for 30 years. Now, granted, you could say, yeah, but you could, Jay Snip. You could get a mortgage and then do what you're talking about now, make big payments, pay the thing off in 10 years. You know what? You're right. That is a possibility. But that also means for the next 10 years, I've got to make giant payments and know that I've got the money coming in for 10 straight years in order to do those 10, make the big payments for 10 years. And that's something I can't say, that I know would none of us do, right? So anyways, just want to just get it out of the way before I start on this. Apartment rents drop as commercial real estate sours. And again, this is exactly what Cliff High said would happen. The bigger, higher end real estate and stuff is going to go down first. This is not the first article about this, but again, it's back in our face again. It's new, so we got to discuss it. Wolf Street, Wolf Richter here on this article. After, it says, and transactions in the apartment sector plunge. After 7 dizzying boom years, commercial real estate prices peaked in December 2016 and have since turned south. These values are collateral for nearly $4 trillion in loans, a good chunk from smaller banks. When the last bubble imploded after September 2007, prices plunged nearly 40%. The Fed has been pointing at the risks the new CRE price bubble poses for the banks. Among the sub-sectors, prices of apartment buildings, according to Green Street's Property Price Index, were down 3% in May year over year. And transaction volume of apartment buildings has plunged. Real Capital Analytics put the story of the apartment sector this way. Activity in this sector, which was the largest and most liquid investment market for the most of 2015 and 16, declined in May and was lower than activity in the office sector. For the year-to-date, transaction volume for apartments is down 25% year over year. This is another side to this equation, the most important, rents, because they pay for the whole construct, including the loans. According to Zumper's National Rent Report for June, rents in multifamily apartment buildings, single-family houses for rent are not included, spiraled into a surprising counter-seasonal drop in June. In other words, surprising means unexpectedly. Summer is peak rental season, meaning it's usually a difficult and expensive time to look for a new apartment, said Zumper, co-founder Taylor Glassmore. However, rents this year are in luck, as median rents are dropping for both 1 and 2 bedrooms nationally. So that's what we're looking at, right? We're looking at rents, which are insane across this country, in most cities for the most part. Out in the country, yeah, you can still get decent deals. But again, if massive population lives in those cities, and 10% live out in the country or 15% live out in the country, well, clearly that doesn't really matter. What matters is where the 85% are living. So when you start to see that decline, again, is it a one-off? Or have we hit peak housing 2.0, as I've been suggesting for quite a while now with all the articles I'm reading? And it's about to start the decline. A much-needed decline, by the way. Now, of course, if you're at your house and you're living on your high horse at the moment, oh, my house is worth, twice as much as it was even a few years ago. This is great. As I said before, you may want to consider selling the house, take the big profit, go rent for a little while, as in possibly a couple years, 2-3 years maybe. And yes, maybe you're paying a little higher rent at the moment, but as they come down, that'll be good, right? And then in 2 or 3 years, when the housing prices really reflect, like, oh my gosh, they're way down, then you can pounce with your cash, right? That's how I would have liked to have done this. And I've said in the beginning, I'd like to have done it that way. But when a certain opportunity is punching your mouth loose, I'm here, I'm not going away, come get me. Sometimes you got to pounce early, okay? You know my story. Which I'm not, maybe I will show the chart. Let's pull this up. The chart below shows the monthly percentage change in median asking rent since June 2016. Note the seasonal surge in early spring and then the sudden drop in June. That's when the median asking rent, instead of rising, dropped 1.7% for 1-bedroom apartments, which is the blue line, and 1.8% for 2-bedroom apartments, which is the red line or pinkish color. Both where they'd been in June 2016, as you can see from left to right. So it did come down a little bit, then it spiking again, and then it's down again. So are we going to see the same kind of activity where, well, it's just a one-off going back up higher? Or is there an actual trend? again, I'm just seeing where everything's at these days and how everybody's so broke and everyone's spending so much money on housing and rent and no money left for anything else. You and I think both know how this is going to end. Prices have to come down. Rents fall in the most expensive markets. Cha-ching, Webbot. Yes, we know. In San Francisco, the median asking rent for a one-bedroom apartment dropped 1.7% in June from a year ago and to $3,450 rent, and is down 6% from the peak in October of 2015. For a two-bedroom, the median asking rent dropped 5.7% year over year to $4,500 and is down 10% from the peak in October of 2015. $3,450 for a one-bedroom apartment. $4,500 for a two-bedroom. I don't know how in the hell you people in that area in California are surviving. And secondly, I don't know why you choose to stay there and do whatever the hell you're doing with this kind of insanity. I really don't. But you may reply, Joe, we get really good paying jobs out here. And yeah, most of it goes to the house. But if I move, I don't exactly have a job lined up. And I get it. I understand. So I'll go ahead and say that as if you said it, because I know that would be a good response. The last period of year-over-year declines in San Francisco ended in April 2010. This time, there was no financial crisis. There is, however, a housing crisis, where the middle class can no longer afford to move into a modest apartment. And this has consequences. And as Exodus has started, Exodus out. No, I'm not talking about the Exodus cryptocurrency wallet. An exodus, a mass exodus. In New York City, the median asking rent for a one-bedroom dropped 7.5% year over year to $2,950 and is down 12.5% from the peak in March of 2016, again, just a year ago. For two bedrooms, it dropped almost 7% and is down 15.8% from the peak. Again, is this a one-off? I don't think so. This is now the trend. And again, rightfully so. In San Jose, median asking rent for a one-bedroom rose 4.8% year over year to $2,390, but is down 1.6% from the peak in April 2016. For a two-bedroom, it fell 2.4% year over year to $2,830 and is down 8.1% from the peak. All right, so we've got San Jose, we've got New York City, we've got San Francisco. These are major cities. We're seeing it everywhere. And I don't really need to show you this particular part, but it says this table of 12 most expensive large rental markets in the U.S. shows median asking rents this year over year changes, or not this, but their year over year changes, and in the shaded areas, the prior record and the change since then. Bottom line is, most everywhere is down. There's a few green ones, but most everywhere down, 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 down. Note the double-digit plunges from the peak in New York City, Oakland, Honolulu, and Chicago. Asking rents do not include incentives such as 1 month free. In San Francisco, a historic construction boom is flooding the rental market with high-end apartments and condos, but employment in May dropped to where it had been in July 2016, and the labor force dropped to where it had been in March 2016. Landlords are trying to fill their units and incentives, a trick to keep asking rents high and make the market look better, have become common. What gives? In some mid-tier rental markets, asking rents are soaring in the double digits, and in most other areas, they're rising by smaller amounts, though there are now some other markets where rents are heading down sharply, including Chattanooga, Tennessee, where the median asking rent for a one-bedroom dropped 12%, and for a two-bedroom, 15.6%. Here are some of the mid-tier markets with the large year-over-year rent increases. So Nashville's gone up 15% and 13%, I guess 1 and 2 bedrooms. Sacramento 15% and 15%. Charlotte, North Carolina 15 and 11. Houston 15 14. Durham, North Carolina 15 and 12. So again, we still do see some rising, but in some of the key, again, the higher end, real higher end areas, that's the telltale sign. And again, this is like always where it happens. So if you have to gauge, I'm going to read a magic crystal ball. The first thing the crystal ball is going to say is, listen, how's the high-end real estate looking? Oh, it's not looking good at all. Okay, well, in the next few years, the rest of it's going down the tubes. Okay, thanks, crystal ball. That was easy. Oh, and by the way, says crystal ball, you can use this formula every single time. Okay, appreciate that. Few workers receive those kinds of pay increases. So again, talking about the ones I just read you from Nashville, Charlotte, Houston, Durham. Few workers receive those kind of pay increases. In other words, your rent just went up 15%, 12%. What? Excuse me? Yeah. So these surging asking rents pressure consumers and cause them to cut back in other areas. Spending for other parts of this economy that needs to be stimulated. Small businesses, medium businesses, everything is affected because the mass money is going to rent, mortgage, rent, mortgage, rent, mortgage. That's it. That's where everybody's money is going. Which again means what? People are going to have to walk from their houses again. There's going to be bankruptcies and there's going to be foreclosures and it's going to start all over again. We fixed nothing and only made it worse since 2008. And for the national numbers, the plunging rents in Honolulu and the soaring rents in Sacramento and all the ups and downs everywhere else get neatly averaged out to actually, believe this or not, 0% rent growth year over year when you combine all the areas. So we have massive increases over here, massive decreases over here, but when you even them all out, everything zeroes out. Yeah, there's no problem with that. There's not going to be an issue with that, not at all. And that hasn't happened since rent started soaring in the Federal Reserve-inspired asset bubble euphoria that followed the financial crisis. Below is Zumper's complete list of the top 100 most expensive rental markets and price movements. Check out your city. Click on the image to enlarge. Commercial and residential real estate price bubbles can choke the economy, the consequences of which are now visible in San Francisco. So let's see. We have any Florida? Fort Lauderdale. Month over month is down 0.5%, but year over year is up 0.7. 2 bedrooms looks like year over year is month over month is flat. Year over year is down 6.4%. That's Fort Lauderdale, Florida. I'm looking at any other thing in Florida if I can find it. Orlando. Month over month is down nearly 2%. Year over year, up 10%. 2 bedrooms, same thing. 8.5% up. Month over month is flat. Tampa, Florida, that's what Papa was looking for. And St. Pete. Let's see. Tampa has increased month over month 1.9%. Year over year, 10.5%. Same with 2 bedrooms, 0% month over month and 9.8%. Tampa, again, everybody's moving to Florida. Right? Remember that? And then we have St. Pete, which is not too far away, St. Petersburg. 1.1% month over month and nearly 16% year over year. Month over month for a 2 bedroom is down 1.4%, but up 9.2%. So there's still some areas that need to get hit with the ugly stick, apparently, right? But again, you can have this is a prime example. Illinois, we're raising taxes, we're doing this, we're done, we're leaving. The big high-end earners in that state, we're leaving, we're going to Florida. Hedge funds, remember that story? And then what happened recently? Connecticut, I just did that video. Same story, they're going to have to raise taxes and everything else because they're falling right behind like Illinois is. And what was the response? The high earners, they're moving to Florida. Both cases, we're moving to Florida. Like I said from the Jerky Boys, Pablo, honey, please come to Florida. We miss you, honey. And Joe says, no, don't come here. You're making everything expensive for everybody. So anyways, still worth totally talking about this. Again, there's ups and there's big ups. Look at, again, Chattanooga year over year is down for 2 bedrooms, 15.6%. Is that, yeah, Chattanooga, which is weird. Hold on. Oh, okay. That was Nashville. Never mind. All right, I'm done. On to the next one. Take care.